following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a fun and profitable and safe trading week. I know it's been a long time since we talked to you last. We've had a bit of a abbreviated schedule lately, but Don and I are getting back on the regular schedule of recording on Fridays and putting the show out for you guys to download and stream on Monday morning. And so you'll be listening to this hopefully on Monday, and everything will be right with the world again. No more of those Wednesday releases like we had last week. But as a result, we are doing two shows relatively close to each other, so the amount of activity we can review and discuss is a little bit abbreviated, but nonetheless, we have some interesting stuff to discuss today. My name is Mark Longo from theoptionsinsider.com, and I will be your host for this volatility extravaganza. And I am joined by the man, the myth, indeed the legend himself, none other than Don Schlesinger from the Volatility Exchange. Don, how are you doing today?
Everything good, Mark. We have to stop meeting like this.
I know. My wife's getting a little suspicious, I think. How is everything out in Donald Schlesinger land these days?
Everything is great. We finally have a tremendously beautiful stretch of weather, clear, sunny, low humidity. It's like they're paying us back for the spring that never was here, and let's hope that it lasts.
Are you cleaning up in track season?
Yep, we're in the home stretch. Quite literally, we have our state qualifying meets for the state championships yesterday and today. And next week will be the state championship, so we're getting to the end of the line, and that's always been a source of pleasure for me.
It's fun to do, and it's fun to have it be finished with, I'm sure, too. It's kind of like I was talking to someone the other day about boating, and they were repeating that old adage that the two best days in a boat owner's life are the day you buy it and the day you sell it, and I'm sure that's probably similar. I have
friends that I know that to be true.
All right, and with that, we're going to roll right into our abbreviated volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is where, as the name implies, we review the volatility activity for the past week, or in this case, the past few days. And we'll kick things off by tossing it over to our volatility pit reporter, good old Mark Sebastian from optionpit.com. Take it away, Mark.
Kind of an interesting week this week. We had a real disconnect between implied volatility and realized volatility. We had a major uptick in realized volatility, but we didn't see a corresponding uptick in implied volatility, at least not one that met the amount of price movement we've been seeing in the actual general market. If only there was some sort of contract that could help me take advantage of realized volatility on something like the S&P 500, I think that'd be a really good product to have right about now.
Yeah, gotta go OTC.
I know. I mean, this is exactly the type of market that makes people want to trade variance and volatility swaps instead of trading contracts like VIX, because what we're going through right now, the VIX isn't hedging anything right now. S&P 500 puts are not hedging. The only type of contracts that are really hedging are these variance swaps. That's it.
Well, this kind of puts the lie to the whole argument that, VIX is a perfect inverse correlation for the market and you should have it as your downside protection, as it were, for the S&P.
Well, no, I mean, it's not perfect. What do they say? It's 80% effective. And yeah, it's been up a little bit, but only incrementally. And really kind of just down on some of these other days. I mean, it's been really, this was kind of interesting. On Thursday, we closed at around 13.15 with an at-the-money volatility in the SPX of 1575. And then on Friday, we closed at 1300 with an at-the-money volatility of 1575. So kind of just a really weird market. And, you can make arguments for weekend effect and things like that, but you can't. 12 handles down should more than make up for any weekend effect.
You'd think, yeah.
So, you would think. So it was just a really creepy week. I just wrote an article for The Street called The Rubber Band Effect. And I really feel like we've got people playing this kind of what Bill Luby would call a strangle pong, where they're bouncing puts and calls off of each other. But, at some point that ball's going to get past that paddle and it's going to get ugly. So
that's a dangerous game of pong.
I know. So, but that's why I don't think Bill plays it very often. But it's just this has been a really weird week.
All right, thank you for that, Mark. And of course, here on Volatility Views, we cover the broad purview of volatility products, and that does include the currencies. So, Mr. Schlesinger, what are we seeing in the world of Eurovol these days?
Well, today's an expiration day, so those are always fun. And the listeners who may have been checking our website know that in the past, the first three had some very volatile moves, as much as 30% moves. The recent one seems to have been somewhat a bit more stable, but still provided some good trading opportunities. And we have the simultaneous expiration this afternoon of both the June 1 vol, the 1 month volatility futures contract, and the June 3 vol that encompassed the 3 months of trading that end today. And just very briefly want to point out once again, we've gotten questions along the way as we do our presentations and we go to some of the exchanges and some of the investment banks. When people learn about the manner in which vol contracts are settled, which is to calculate the number of returns in the period, they say, gee, well, when you get to the last day, like here we are today for the expiration, and there were 19 days in the 1 month cycle, for example, what's the incentive to trade? These things must not move at all. You've got all your data points but one in there. So what could happen? And the answer is a lot can happen. And to give you just a very quick overview, the settlement price of the 1 vol last night was 10.40, and the partial vol for the 18 days that had already been logged was 10.36, very much in line with the settlement. So what could happen today on the last day? Well, nothing could happen. The euro could be unchanged on the day, furnishing a zero volatility data point for the 1 day, and that would bring the value down a little bit. It would actually go from the 1036 partial vol or the 1040 settlement down to about 1008 or so. So it would drop about 28 cents. But then you look at the flip side and you see the potential, if there is movement, even of 1 day's period. And so what if there were, for example, a 1% move in the euro today? Well, the settlement would be 1073, and that would be up 37, which is more than if absolutely nothing happened whatsoever. And if you had as much as a 2% movement, that single day of 2% volatility, since it's a square factor that we do that root mean square calculation, would actually send the final value from 1040 all the way to $12.47, or an increase of over $2 or over 20% in one single day. So I simply invite listeners to understand, we all know what happened in the equity markets and the stock market 2 days ago on Wednesday, and just take a look at what that one single day of volatility could have done if it were toward the end of the expiration cycle for a vol contract. So the takeaway from all of this is that don't let anybody tell you that when you're calculating realized volatility and you're accumulating data points that you can't have action, you can't have price movement right up until the last minute of the last day, because you most certainly can.
It's amazing to me that these questions are still coming up. Haven't they listened to the show, Don? I think next time you guys do a road trip, you should just send ahead a few episodes of Vol Views where we've discussed the various ways that these contracts can perform and indeed continue to move and vacillate right up until the final day. So I think that question has been settled. Who's still asking this question, Don? We'll have to.
Well, that's a great idea. What we'll have to do is send a little homework ahead and say we'll meet with you, but you've got an assignment
there
first.
We go. I find that works very well. People usually respond very well to that sort of thing when you do that. Hey, just have them call me, tell you what, and I'll set them straight for you, Don.
There you go.
All right. Before we close out the old vol review, I should just let our listeners know what we're seeing right now in the broad market as we're recording this, and we're recording this on Friday afternoon, and it is a slight downside day. Certainly nothing like what we saw a couple days ago in the market, where the Dow is down about 46 handles, the S&P's down about 5.5, the Nasdaq's down about 18, and the VIX cash following suit down 0.83 to 1726. So that gets into our discussion many times we've had about VIX's suitability as a hedge and all the other factors that go into that number, like weekend and time decay and skew and other things that make it perform not exactly perfectly as a hedge for the broad market. So that's what we're seeing right now. Nothing really lighting up the tape that is meriting a significant discussion in the vol review. Just want to let our listeners know what's going on right now. And that is going to do it for the volatility review. And with that, we'll roll right into our volatility viewpoint segment.
May I have your attention, please? Quiet, please. It's time for the Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is usually the segment of the show where Don and I bring a guest along and we pick their brain about some aspect of volatility and volatility trading. But since our guest roster is so jam-packed for the next few weeks, Don and I thought we'd take this opportunity to instead discuss some other interesting topics that may be of interest to our listeners. And one of the things we've bandied about for a while and thought would make an interesting topic on the show is indeed the places we go and the places we look for information on volatility and some of the reliable resources and the destinations we go to online and otherwise when we're looking to compile information and analyze the world of volatility. And I know, Don, you've been putting together a nice little collection over there in anticipation of doing a show like this. So why don't you kick it off for us and run down some of your favorite destinations, favorite places, favorite sources of volatility information?
I think it's very important for our listeners that they be able to have references and resources. And obviously, back in the day when I was on a trading desk, I wish that we had available the incredible amount of information at our fingertips that the internet provides, of course, which is not to say that there aren't some good old-fashioned terrific books out there as well. I just finished reading one that I would highly recommend to our listeners, and I'll mention it in a moment. But as a start, I'd like to point out that on our own website, volex.us, we have in the resources section two distinct categories. One of them is called Volatility Links, and the other is the Volatility Library, and I'll explain the difference in a minute. But in the volatility links, we have several different sections, and we start out with definitions where we talk about standard deviation, the Black-Scholes options pricing model, the black model, and the links take you to various articles and discussions of those particular topics. We've just recently added, in fact, since the last show, so this is brand new, a section that we are calling courses, where there are actually online educational materials. We'll be adding to that, but we put the first one in just last night, and it is something that is offered by the London Financial Studies Group called Volatility, Trading and Managing Risk. So whereas we're not a sponsor for them, and the disclaimer is that this is for informational purposes only, and we don't endorse or are not affiliated with the organization, we once again want to bring it to the attention of our listeners that there is a great wealth of educational material out there.
This is interesting. I haven't seen this before on the website. Obviously, this is brand new. So I'm on the volex.us now, and where do I go to find the courses?
You take the pull-down menu, which is data.
Mm-hmm. Oh, data.
And
okay.
As the subset of data, I'm sorry, excuse me. I apologize. You take the resources section right underneath data, and under resources, you'll have volatility links at the bottom. And then in volatility links, when we used to have the
okay, I see. It's like triple buried under navigation. But listeners, yeah, if you want to find it, go to volex.us and then go into the data. I'm sorry, Don got me too. Resources and then volatility links, and click on there, and I see it now in the courses. Yes, very interesting.
So when you go beyond that, you start to look at the heart of the entire application, which is the research papers. And our chairman, Bob Krause, and I have really diligently combed the internet for all of the pertinent academic papers that have been written over the years, and some of them brand new, and some of them going back in time, some of the classics. And there is a tremendous array of information here. One of the things I'd like to point out to listeners, and I think it's important, and that is, if you've ever tried to read one of these academic papers, they can be very intimidating. A lot of them are very math intensive.
Yeah, they're not written for the casual read.
And I'm not a theoretical mathematician either. As a friend of mine used to say, as soon as they start putting all the squiggles in there, that's where they lose me, and I don't follow them anymore. Well, that's really the case for me also. I have a pretty good grounding in practical applications of mathematics and probability theory and a lot of the things that go into some of the modeling. But I never fancied myself as a theoretical mathematician. But I wanted to pass along some of my own experiences in reading some of these papers, and maybe listeners can glean something from that. If you have read some of them, you know that the format is identical just about for all of them. And they start out with an abstract, and the abstract is nothing more than an introductory paragraph or two, which is intended to be a summary and an introduction to the topic, to the findings, what's new, what have we done that's different here. And, you know, the old saying, tell them what you're going to do it, and then tell them that you did it, you know, when you're writing something. So the abstract is tell them what you're going to do. And then comes the body of the paper, and that's where you can run into a great deal of the exposition, which is the mathematics supporting whatever the study may be. But I've always found that it's possible to simply look beyond the mathematics if it's too complicated or you simply aren't able to follow or understand it, and read all of the connecting words and read the paragraphs and read the description of what's going on and what the central thesis is or the crux of the matter. And finally, of course, if you make your way through that, you come to the conclusions and findings and tables and the numbers that may be helpful, and you see what has been demonstrated and what's new and what has been brought to the table that wasn't there before. And when Bob and I are debating and discussing various issues, and he's trying to prove his point or I'm trying to prove mine, I often just simply cut and paste those conclusions and say, see here, this is what they found right there. So there's a wealth of material out there and some extremely fascinating papers on every conceivable topic of volatility: implied, realized, modeling, forecasting, surfaces. There's been an explosion of interest in volatility, not just in volatility trading and products, but in volatility research as well. And the academics are producing papers at an incredible pace. If readers really want to get a taste of one of the most brilliant academics out there, happens to be a friend of ours and a former colleague at Morgan Stanley. His name is Peter Carr, C-A-R-R. Name may be familiar to those people who are students of volatility. And we have his entire body of research as one of the links. It simply says Peter Carr's research. And just clicking on it is a memorable experience, because you'll see a list of papers that this man has produced that is really extremely impressive. It's mind-boggling what he does. And used to have meetings with him, and he was a former member of our board of directors, and as he'd be sitting there, he'd be scribbling on a legal pad and kind of like working out an idea for his next paper or his current paper, even as he was interacting with us. So this is one of the brilliant minds in the area, and listeners could do well to look over some of his research. In addition to these volatility links in the reference section, we have what we call the volatility library. And the volatility library is intended to kind of do the work for you if you're a little bit too lazy to look through everything that I just discussed. And so the volatility library kind of highlights every week or so a new paper, sort of the feature one. For example, the last date is May the 30th, so 4 or 5 days ago, and it's called Towards a Theory of Volatility Trading. And coincidentally, I didn't even know that, I just pulled it up, it is a paper by Peter Carr and his colleague Dilip Madan, with whom he writes a lot of articles. And so what we do is we feature an article, and then we also have the recent ones, so you can go back 4 or 5. And if you're looking, we categorize them as to whether they are articles on hedging or implied volatility or realized or investing ideas or trading ideas. So what we do in the library is simply organize things for you rather than simply list them all, and make them a little bit more manageable and a little bit easier to find. So
yeah, I have to second that nod to the volatility library you guys have put together, because ever since you guys started compiling that library and posting on your website, I find myself going to it more and more often. It is, as you say, a one-stop shop for a lot of volatility, different research and papers and ideas and articles. There's article links as well. People should know that, it's not just dense papers, academic papers on volatility. There's links to a variety of articles, and I'm looking at one right now about the issues with the VIX settlement process, which is an article from you linked to from FT.com. So there's a lot of interesting things in there that cover the whole gamut of volatility, and it's increasingly become easy for me then to be lazy and just go to your volatility library and let you and Norm and the rest of the team over there do all the work for me. So I take my hat off to you, sir, and for making my life a little bit easier.
Well, thank you. And one or two other sites that I've liked over the years. This one has some very, very lively forums with some of the most brilliant financial engineers and traders out there. It's London-based, and it's Wilmot, WILMOTT.com. That's Paul Wilmot, who is one of the world's foremost financial engineers and authorities on the mathematics of finance. So there are many, many lively discussions and lots of terrific information there. On a slightly more practical level, Peter Hoadley, Hoadley. We have a link to him on our resources page, but that one is hoadley.net, N-E-T, rather than .com. And he has a wealth of information having to do with also financial engineering, and basically has online calculators, implied volatility calculators, portfolio optimizers, Black-Scholes and other pricing models. Some of it is free, some of it you have to subscribe to, but again, I found it to be extremely reliable. Finally, of course, there's Robert Engel's Volatility Institute. And so we have the V-Lab that we have discussed on several occasions, and the fact that at the Volatility Institute, which is housed at the NYU Stern School of Business, we have forecasts of volatility using the famous Garch models that Robert Engel pioneered. And if you heard that show when he was on as our guest, you heard him speaking about that. That one can be found through the nyu.edu/volatility application in terms of their website. And you have not only the Volatility Institute, but the subset of that, V-Lab, V-L-A-B, Volatility Lab, where he publishes all of his forecasts and studies and modeling. So tremendous amount of information there. Finally, to conclude in terms of information, people still do read books, I'm told, and
heresy.
Some people may think they're out of fashion. I'd mention just a couple of the most well-known and most famous. If you're going to talk about volatility or options pricing or the world of options and volatility, it might have all started with Larry McMillan and Options as a Strategic Investment, still a wonderful, wonderful reference work of over 1,000 pages with many, many discussions and treatments of volatility and volatility trading. Another very highly regarded work by a former floor trader on the CBOE, Shelley Natenberg, is Option Volatility and Pricing, which is really become a staple and a very highly respected work. Of course, there's John Hull, a little bit heavier sledding, more mathematics, options, futures, and other derivative securities, but Hull sort of wrote the Bible on all of the mathematics of these instruments. And I'd mention one final one, and that was a recent read by Ewan, E-U-A-N, Sinclair. And Ewan Sinclair has written an excellent book on volatility trading. And he has some very interesting ideas. They're very well expressed. He's very thorough in his documentation and quoting formulas and papers, so you don't just take his word for something. He backs it up. There's an extensive bibliography. There's a CD that comes along with it with spreadsheets for modeling and following along some of the things that he does in the book. So an excellent read that I can recommend to our listeners as well.
Yeah, I have to second a lot of those recommendations. Obviously, Natenberg, in many ways, the Bible for out here in Chicago. If you were a floor trader or you were coming up through the pits, you were handed the Natenberg option volatility and pricing as soon as you walked in the door, and that was meant to be your manual, your Bible for options trading, and it all started from there for a lot of people, myself included. That was the first tome I was handed when I landed in Chicago, pretty much.
It's all, don't come back until you've read it.
Exactly. Go pick up. And Macmillan, you can say the same thing for Macmillan. He was given essentially the options industry's Lifetime Achievement Award down at the OIC conference this year, and he was at my table during one of the final reception dinners. So I had a chance to chat with him a little bit, and we had a lively discussion about the weekly options, actually, and how he feels that they are significantly overpriced these days, and the market hasn't gotten a handle yet on how to accurately price the volatility and the decay in these options. So as a result, he's been a heavy premium seller in weeklies lately. Apparently, that's his new thing that he's on.
Pretty funny that you should mention that, because Bob and I were talking about the potential for volatility contracts that would mirror these expirations on a shorter term, which if you think there's volatility in a 1-month contract, imagine what there might be in a 1-week contract. And Bob actually sent me a screenshot of the S&P weekly options last night, and he said, boy, maybe we're missing the boat. Maybe we should just set up a trading operation. Look at these implied volatilities. And I took a look at some of these options, and I had to keep myself from drooling, because I guess Larry has discovered this a little bit sooner than we have. But they obviously probably, once again, the sellers demanding tremendous premiums because of the potential for extreme volatility over such a very short period of time. But
I imagine your old strangle-selling blood was, you're getting the itch again, aren't you?
Well, it certainly was tempting taking a look, but I think that probably it would be a wonderful idea for us to reach out to Larry and have him as a guest in the future. Before we sign off today, since we're getting closer to it, actually beginning next week, I'll give you a very quick rundown of our future guests in the weeks to come. But it would be nice if we could reach out to Larry and perhaps get him on sometime down the line.
Yeah, that'd be interesting to do, too. And it might also be interesting to discuss down the road a little bit how these weeklies are impacting options trading right now. I mean, we've seen a significant impact in names that have weeklies listed in them in terms of how the volatility trading, the premium trading, the time decay trading has shifted. And if you are, as you were, Don, a strangle seller, a premium seller, someone who tends to lean on the short side of the spectrum, the vast majority of that activity has migrated to the weeklies now. So we're seeing a very bifurcated volatility structure or open interest, where all the short open interest is migrating to those weeklies and the long open interest is in the front month and beyond. And so it's kind of interesting to see how that dynamic is starting to impact the way these options perform.
So you're basically saying that as we explore the possibility of actually down the road introducing the potential for volatility contracts on an even shorter term basis, the public may have an appetite for that. And if we're in the business of providing what the public wants, perhaps that's something that we will be looking at down the road.
Yes. Short term, that's the hot thing these days, Don. They want daily vol, I guess you can say, or one day.
Action by the minute. Just roll them, huh?
Yeah, you laugh, but you wouldn't believe how many calls I get on a weekly basis from overseas binary options exchanges, quote unquote exchanges. Usually one guy in a room, and they have 5-minute and shorter contracts. So it's getting pretty insane out there in terms of the actual duration of some of these crazy OTC currency binary products that are out there. It's becoming a bit of a free-for-all. Before we close out this segment, I want to throw in a few interesting suggestions as well. It's kind of this first one I have. I mean, you mentioned a lot of the academic and the financial engineering side of it. And for our listeners who also want to just reads about volatility maybe on a more retail perspective, or aren't looking for formulas in terms of how to program their own volatility model, there are some interesting websites and blogs out there to surf on. Of course, one of our guests coming up is Bill Luby, and he has that VIX and More blog, which is pretty widely followed on the retail space if you're looking for insight into those products. And as the name implies, it is primarily a VIX destination, but that's a good site to go and read his stuff, as well as some of the commenters on there and some of the other links and articles he has on there. It's a pretty good one-stop shop for a variety of links and recommendations for VIX information. I know also one of his cohorts over at Expiring Monthly and has written a book, which I was looking at, and Don, you sent me the link to. I know you're looking at as well, which is, of course, Jared Woodard over at Condor Options, and they're a service that essentially, as you might guess from the name, recommends condor options trading, iron condors primarily, but he has a new book out called Volatility Risk Premium. Just came out. I haven't had a chance to read it, and I believe it is an ebook format only, but it seems interesting, and it gets into a lot of what we have been discussing, you and I, about that risk premium that is being built into the options these days.
I looked at that with great interest, and I'd like to see if we can eventually obtain that and read through it. It's always a little bit harder when things are e-books. You have to stay at your computer and read everything. You can't kind of take it around with you, although these days you do take your computers around with you, or the tablets.
Copy it on the old iPad or the Kindle, and you're good to go.
You got it.
But yeah, and those are some good, I think, destinations for people who are trading options on a regular basis and want a little bit more insight into these products, but perhaps don't want to dive into the depths of, let's say, the Wilmot forums, where they will debate the various nuances of the formulas used to construct your models. If that's a little bit too wonky for you, then these are some good suggestions. And of course, I would be remiss if I did not also plug our own Options Insider volatility section if you go to the optionsinsider.com and then click on the old trading and technology section, you'll see one of those subsections. There is indeed volatility, and you could peruse through a lot of information and articles there, as well as, of course, posting in our forum where our listeners and our readers will be more than happy to engage you in a discussion on volatility. And I think that's going to do it for this Volatility Viewpoint segment. And with that, we're going to roll right into the old crystal ball.
And now we take a look at the crystal ball.
And welcome to our Crystal Ball segment. This is, of course, where we discuss what's on our horizons and what we may be anticipating in terms of the upcoming trading sessions from a volatility perspective. And we're going to kick things off with good old Mark Sebastian from OptionPit.com, our volatility pit reporter. Mr. Sebastian, what is in your crystal ball for this week?
You know, if we can get the SPX to break 1295, 1294, I think you're going to see that's where we start seeing a real uptick in implied volatility. Maybe. I think oil vol is going to be coming in, gold and silver, the metal vol, mini and full size metals volatility. I'm expecting to come in, but watch those broad market indexes. If we can get kind of beyond where people are willing to kind of hold the line, I think that this thing the wheels could really, really pop off. Otherwise, we may just get another bounce and be heading toward a VIX of 13. So
yeah, so far, I mean, we're recording this on a little late on Monday morning, and so far the markets are relatively, drifting slightly downward, but nothing too harsh. I mean,
watch where we are. If we can kind of get below that 1295, 1290 level, I think that there's going to be some people starting to get worried that are short those 1300s and 1275s, because we've been seeing a lot of premium selling into all these downtrends. It's really creepy, but that's what I've been seeing.
another day when the broad market is down and the VIX cash is down as well. So
Great.
there you go. And we did talk on one of our other shows recently about how that 1300 level in the S&P is so important from a psychological perspective. And even the non-farms completely missing didn't break that 1300 level. It looked like we finally did it today, but just barely. So we'll see if we hold this level below 1300 today or if we just bounce back and we start playing your strangle pong again, as your friend is wont to say.
Right. It's great. So,
all right, Mr. Sebastian, thank you for that. And of course, we do cover the whole purview of volatility here, and that includes the old currencies. So, Mr. Schlesinger, what are you expecting to see? Obviously, we have expiration today, so that's going to be a big data point for you guys. And then, of course, I know we've discussed on the recent shows the possibility of some arb coming in between those contracts. Have you seen any of that materializing?
Well, we settled things today, so things are pretty much in line, and whatever discrepancies we discussed in previous shows that were there did in fact come out rather quickly. Of course, with the expiration today comes the new cycle, and that'll be the July 1 vol along with the September 3 vol or 3-month contract. And it just may be interesting to note, not that I'm the least bit surprised, that although settlement today looks like it'll be in the mid-10s somewhere for both contracts, you've got the July 1 vol opening with a settlement yesterday at 1169, opening its realized volatility period. It has been trading for a while, but now as of Monday, we start calculating the actual returns on what's going to be a 25-day realized volatility period or calculation period. Last one was only 18 days. And the September is starting the first of 69 days, and that settled at 1233 yesterday. So you've once again got premium in both of these contracts somewhat above what the recent settlement is. Again, no surprise, and we've discussed the reasons for that, but it'll be interesting to watch over time.
All right, and that's going to do it for the Crystal Ball segment, and it's also going to do it for this episode of Volatility Views. I want to thank my co-host, my partner in crime, good old Don Schlesinger from the Volatility Exchange, for joining me today. And before we go, Don, I know we've already discussed the new volatility courses you have coming up on the website. Is there anything else going on at volex.us that you want to let our listeners know about?
Well, we continue to try to strive to bring all the latest information possible and make the website something where people can go for one-stop shopping to know all that there is to know about volatility. We're, of course, working behind the scenes to try to bring out new products and try to expand our universe of trading so that one day we meet those goals of being the place where people will come to trade volatility. Before we go, I'd like to run down really quickly this rather impressive list of guests that we have coming up so that our listeners will make sure to stay tuned over the weeks to come. We're going to kick it off on next Friday. The show is recorded then. It'll probably be released to the site on Monday the 13th. We're going to have Tom Sosnoff here, who was the founder of Think or Swim. It'll be interesting to hear some of his viewpoints. We're going to follow on the 17th with Bill Luby, whom you mentioned just a little while ago, his famous blog, VIX and More, and we should have some lively discussion with Bill. The following week, we have Kirk Northington on from Northington Trading and MetaSwing. Kirk has a technical analysis viewpoint of trying to trade volatility, so it'll be really interesting to see how he looks at it and how he trades it. And then in July, not sure if we have firmed up both of the dates consecutively, but I think that on the 8th, we're going to have Mike Cavanaugh from Know Your Options. And then hopefully within a week or two to follow, an academic, perhaps not everyone knows him. His name is Tom Schneeweiss, very brilliant professor at the University of Massachusetts, and we'll get a look at some of his theories on volatility as well. So a rather impressive list of guests coming up, and hopefully some lively discussions, informative and interesting for all of our listeners.
Yes, I'm looking forward to that as well. It's always fun to mix up the format a little bit and bring in some outside perspectives onto the show. And of course, before we go, I do want to mention as well, we didn't get into the mailbag this week, but we did get a question on our forum that I thought was interesting and worthy of maybe a quick answer, and that falls into this same area of what's coming up, which is, of course, one of our listeners asked if there a way to subscribe to Volatility Views by itself in iTunes as opposed to the entire Options Insider Radio Network, and also perhaps stream it off your website. And both of those things are coming very shortly, I will say. We've made some changes and some upgrades to our systems to be able to handle all of this bandwidth and traffic. That's a good problem to have, which is, of course, people are downloading and streaming the show in large numbers. And so we've made some upgrades to our behind-the-scenes systems, and that will allow this show to go up in iTunes as a separate feed, as well as hopefully soon be able to allow you guys over at volex.us, Don, to stream the show from there as well, and allow listeners to subscribe from there as well. So it should be pretty interesting. And
that's great. We're looking forward to that.
I can already see your webmaster just holding his head. He must dread this show coming out, because every time it comes out, there's something new for him to do. But this is actually a fun development. I think it'll make it even easier for our listeners to find the show and listen to the show, perhaps while they're perusing your volatility library over on volex.us. We don't care where you find it. If you find it on the Options Insider, if you find it in iTunes, if you find it soon to be perhaps on the Volex website, as well as many other leading options or leading online audio destinations around the web. We don't care where you find it or how you listen to it, as long as you do. So we're happy to make it available in more venues and formats for you. And now that is going to do it for this episode of Volatility Views. I want to thank all of our listeners out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.